At the end of each chapter in your packet, we have a liability, which is a liability, yeah. Yeah, we have an outline that's a lecture outline, or it's a textbook outline that basically covers your textbook. And it covers the main points that should be understood after you have finished each one of the chapters. So if you have a highlighter, you can take a highlighter to it and highlight, or you can also make notes as we work our way through this. Most of these chapters will have more learning objectives. Very sensitive here, isn't it? We'll have more learning objectives than we actually will be covering. In this particular one, we did do, for example, learning objective 1. So you should follow the learning objectives which are within your modules, which are also the ones which are within the packet. And those are the ones you'll be responsible for. As you work through here, we talk about current liabilities, and it says the characteristics of liabilities, and I want you to know the definitions that relate back to the past, the present, and the future. And know, as it says here, that it may not be payable in cash. So it may not be payable in cash. It does not have to be cash. There's no requirement that we have to have it in cash. Okay? And it is a present obligation to sacrifice something into the future because we have something that has happened in the past, and it is also a current obligation, which they neglected to put in there. We began our discussion saying that liabilities and assets are opposites. That is important. Very sensitive here, isn't it? I'll get the hang of it before the end of the semester. A current liability, you know, they use this within 1 year, which is really interesting, because we actually said it was operating cycle, but one of the ways that we are going to be handling it, that's a shortcut, if you will, is to say that operating cycle is a year, so then we use the year and we are only looking at a year. And again, in your problems, I'm not going to say just 1 year. It's either going to be months or it's going to be over a year, so you won't have a problem issue there. Current liabilities are recorded at their maturity values, so this is another thing to know. The important thing about this is when we get into our next module, we will not be recording things at maturity values. Instead, we will be talking about their present values. And they say that there's a practical expediency that's involved with this, because if you did present value calculations, you'd be recording interest, you know, just 9 months, and you're recording interest each time, and the interest amount would also be small because the present value over a short period of time is not much difference from the future value, which is maturity value. So the practicality of the thing causes us to record things not at the present value, even though conceptually, as they say here, all liabilities should be recorded at their present value. Main reason why we don't do it, if someone asks, it's materiality. It's not material. Whether we record it at maturity value, which is the amount that will be paid at the end, or whether we take the present value. This is when we initially record the liability. Okay. Okay, you should probably just reading through this. I don't believe I covered too much of it in great detail in class. Down here it discusses what an accrued liability is. And my distinction for you was that an accrued liability is different from a contingency. And I think there was some confusion also about this within our problems, in that they sometimes confused accrued liabilities and contingencies. And I believe we now understand the difference. There's an example here of vacation pay and when we would record it. And it is recorded when there is a liability. And a part of that is whether it is vested or actually owed to the employee. And this is consistent, very much consistent with what we talk about when we talk about when we record a liability and when we don't record a liability. This advanced collection is a deposit situation, and we said when we have deposits we should record then a liability because we owe them back to the customers. And then there's another example in here besides the deposits, and our example was the utility deposits, which is gift cards. And gift cards we talked about, and we said we record them as deferred revenue when sold, and then recognize the revenue if the gift card is redeemed or the probability of redemption is remote, which means we have what we call breakage. Okay. Then the other thing to look at here is to continue on this, and we talked about how that if we have something that is technically a non-current liability, we still need to look at the current portion and record it in the current section. We have something on demand, it is also recorded as a current liability. Then we did not talk about, I should say this, and I need to talk about it here, is that you can move a short-term obligation into the category of long-term non-current if you intend to refinance it as a long-term and you have the ability to do that. If you have the ability to do that, then you can reclassify anything which is recorded as a short-term obligation as a long-term. Now, what's the benefits of actually doing this? The benefit is that the reader of the financial statement is going to look at those quick ratios or the ratio, working capital ratio, and it's going to make you look better if you get to do this. However, I would caution, if you're a company that tries to get away with not showing a current liability as a current liability by pretending that you are going to refinance on long term and you never ever refinance on long term, I don't think you can get away with that indefinitely. The next topic which we covered, which you notice is in a separate section than accruals because it's different, is a loss contingency. And a loss contingency, a contingency means that it's going to only be completely resolved when something happens in the future. And they define that here. The thing I said about it, the first thing you really have to have before you can call it this, though, is getting all this highlighted. The thing that you really have to do here before you can call it a contingency is you have to have a liability. So some of the examples they had were not really truly liabilities, therefore I excluded them, and some of them were accrued expenses, which are not contingencies. To be able to accrue it, you have to have an estimate, and you can't get out of recording this loss contingency by saying I can't come up with an estimate. You have to really make a concerted effort, go and talk to the people who should know about the potential loss, such as a lawyer in a lawsuit, so talk to your legal team, and come up with a number. If it's probable, and you can come up with a number, you have to do it. These other examples I don't really like so much, so I'm going to kind of skip forward right here. So it must be probable that an unasserted claim or assessment or an unfiled lawsuit will occur before you consider how to report it, before you even try to estimate it. Is a claim or assessment probable? If it's probable, you're going to have to do it. And then you say, well, what's dollar amount? Can we estimate it? So there's a number of, there's step process that I didn't particularly go through all these steps with you, but just know that if you anticipate a loss and the loss is probable, you are going to have to do a journal entry as long as you can come up with a number. That's all we really need to know here. There is another bit, though, I should say, up here under E, we did cover, and I need you to know this. And this is when the loss contingency occurs before year end and some clarifying event happens. What they're saying is you have a better idea of what it is, then you need to report the updated amount. Okay? And we did that also, I think, in what we were doing. Alrighty, now going ahead here, there is a discussion in this area. Pardon me as I skip around here. We've covered all of this. We covered loss contingencies, a gain contingency. The reason why I don't really call it a contingency again is because there is not really a liability. With the gain contingency, you're saying that I'm going to debit a receivable and I'm going to credit a gain. Well, you don't get to debit a receivable or credit the gain unless it's virtually certain to occur. And under US GAAP, we usually mean that it is realized. Okay, it is realized. So in this situation, what we are saying is we have actually got the cash in. So I would say that you just hardly never record this, even though you know about it. You do disclose it. It's okay to disclose it, put it in notes, but you cannot record it. In other words, you cannot recognize it. This is conservatism, is what it is. So you give out bad news in your financial statement before you give out good news. So you have to wait till you got the cash in your hand to record a gain, but losses get recorded before there's even any money going out your pocket. There's no money being sent out, but yet you still have to record the gain. So some people argue about this and they say, well, if we really want to be truthful, we should record our losses and gains in the same way. We should have a standard for both that's the same. And this is an argument within the profession. And current GAAP says, well, record losses before they occur and then wait for the gain to actually happen to report it. The other things which we should have just a basic background understanding of, I'm not going to make you do the ratios again. Did not cover Appendix 13 on payroll related liabilities because my assumption is that you covered it quite well in Accounting 201. However, many of the accounts associated with recording of payroll are actually the liabilities. You not only have the amounts which show up as deductions from the paychecks showing up as liability, you have the what we call FUTA and SUTA, the unemployment taxes that show up there as well. In this chapter, we had some other things that fall really closely related to payroll and payroll liabilities, and this included our vacation pay. Sick leave is also something that is a payroll recorded liability. Both vacation pay and sick leave are accrued expenses, and they properly need to be recorded. So as you go through this outline, when we're studying for our exams, you should read through these concepts. They relate back to our specific learning objectives, which also relate back to the specific problems that we worked within the packet. And in your mind, it should all tie together. That's my best advice I have for you to make an A in this class.